Hello.
Hi.
Hi. Can you hear me?
Yeah, I can hear you clearly. Can you hear me?
Yeah, I can hear you. Okay. So, hi. So last time we talked about how PPF should be your main investment and savings scheme, if I were to say, if you are making below a certain level, or even if you are making a lot of money and you're saving a lot of money, PPF should still be the first thing you think about while saving money. Having said that, we also like, so from what I got from last call, let me just summarize it for you. And if I'm wrong somewhere, just let me know because I'm gonna put it in simple terms. The reason why PPF is such an attractive investment opportunity in your mind is because one, it's extremely risk free. It also gives you an interest rate that since there is no tax and you save tax while investing, when you liquidate your PPF, you don't pay any taxes on it. It somewhat just equals to the fact that you earn 14% interest on a mutual fund and then pay, let's say, 40% tax or 33% tax on it, and you end up getting a 8% return nonetheless, which makes it a very good investment opportunity. The other thing that you were also saying is that it also makes a lot of sense for you to invest in a PPF is because when Indian rupee increases in terms of other countries, that also means that the interest that you're getting can buy you more in those other countries. If I were to put it
Uh,
simply.
yeah. Simply put, is that your rupee has become stronger and your rupee can buy you more.
Hmm.
Uh, and because your currency has become stronger and you're getting lump sum currency at a tax exempt, you can do a lot more with that lump sum at that point in time.
Hmm. And all of
So,
this with relatively no risk, right?
not relatively, absolutely no risk.
Okay.
It's the PPF is the only subsidy that is given to the middle class.
Hmm.
All right, it is the only subsidy that is given to the middle class, and there has to be a strong reason to not take it.
Makes sense. Makes
Um,
sense.
so PPF is a mandatory first investment, and it is used as a benchmark with other investments. And obviously, if during the tenure of your holding, if your currency appreciates in value, your
Hmm.
PPF is actually giving you more money, more bang for
Yeah.
the buck
Yeah.
over a 2 decade, 1.5 decade, 2.5 decade period. And there are trends in the market which are suggesting that the rupee might just buckle or reverse its 5 decade, 6 decade long falling currency to either hold the fall completely. And the examples I gave were like the euro has not created a new high against the rupee since 2012. The British pound has not done it. Um, the Japanese yen has certainly not done it.
Hmm.
These are the developed ones. US has done it. But then if you look at entire Latin America, entire Africa, I would say even large amounts of Asia, with the exception of AED,
Hmm.
Singapore, etc. With the exception of these countries, by and large, the rupee would be in the top 95 percentile, 98 percentile of the world in terms of
Okay.
performing currencies.
Hmm.
And that is stronger than what it has been traditionally, and therefore there is a probability that it could reverse its declining trend, which it already has against secondary major economies such as Russian ruble and Turkish lira, Mexican peso, Argentine. I don't know what's the currency. I think it's peso only or lira. I'm not sure, but one of them. It has certainly reversed the trend against those economies to a large extent. The only question is whether or not it'll do it against the US. This is something that we will wait and watch, because how long can the US continue increasing its interest rates? Because
Hmm.
the more they increase their interest rates, and like I said, that countries who have dollar denominated debt, the
Hmm.
greater the burden they feel, it incentivizes them to take debt in other currencies
Currencies.
and therefore forgo the US dollar as the main currency or the main baseline. And so this is where we are seeing the world order shift. Like you would almost certainly see that there are talks of new currency benchmarks like the R5 in the BRICS,
Hmm.
the ruble,
Yeah.
renminbi, the real, and I think one more, South African rand.
Hmm.
The R5, and you will see this huge surge of buying in gold from China, You're seeing this in the price of gold at roughly 70 to $75,000 rupees for 10 grams. You're seeing that in uh, silver, it's 94,000 rupees a kg. It was 37,000 rupees a kg about 5 years back.
Hmm.
So when you're seeing, and it's not just that precious metals are appreciating, all metals are appreciating.
Hmm.
So we are in an environment wherein the commodity market is in a definite bull run. It's in a definite bull run. Commodities are likely to get more expensive, and we have to see this that in the sense that a lot of economies will like to back their currency with some underlying. Some
Hmm.
economies choose gold, some economies might choose copper depending on where they are. And so we have a commodity bull run, and therefore, after you have invested your first 1.5 lakh in PPF,
Hmm.
your next investment has to be 1.5 lakh in the sovereign gold bond.
Hmm.
Why
Okay.
1.5? Because we have put 1 lakh, one unit in risk-free debt market. Now
Hmm.
the other unit has to go in the least possible risk commodity market.
Hmm.
And the only place where we can do that is the sovereign gold bond,
Hmm.
which means India has clarified its interest that we want to back the rupee with gold. And they're asking the retailers to hold it. The problem with holding physical gold is you do not know if you're holding gold with the 4.9 purity or a 9.95 purity or a 9.15 purity, or even if you're holding gold at all in case of
Hmm.
jewelry. So the government is encouraging people, why don't you just have gold in your portfolio, and that stabilizes the rupee even further. There are other reasons also. If the government is to borrow, they would borrow it at 6.5, 7% interest.
Hmm.
Whereas if they borrow it with gold as a backing, they get to borrow it from its own citizens at 2.5% interest, therefore reducing our fiscal deficit and stabilizing our currency to a great deal. So this is the next. There are very few countries in the world which allow individuals to hold gold. Very few countries in the world allow you to do that. India is one of those countries, and Indians should take huge advantage of it. The sovereign gold bond, unlike the PPF, has a shorter duration of lock-in.
Hmm.
It gives you a 2.5% interest, which is comparable to the interest that you would get from real estate. So if you have a house worth 1 crore rupee, let's say in almost any city in the country, Bangalore, Pune, any place, you're
Hmm.
most like which is worth 1 crore rupee today, right? That house is likely to generate give you a rent of 2.5 lakh rupees a year, 20,000 rupees a month.
Hmm.
That is that is the real estate yield actually. So, but the only difference is that gold is giving you that yield with the ability of you being able to buy 1 gram at a time.
Makes sense.
Whereas for real estate, in order to create that 2.5% yield, you most likely have to take on leverage, which is in the form of a loan, which
Hmm.
creates more complexity in the balance sheet. So when 2.5% real time returns, because 2.5% is the real rate of inflation, because that is the rate at which gold is mined across the world, and there are many other reasons for it. If that becomes the secondary objective, the first objective is pure security.
Hmm.
Security by placing it in the bond market, and the bond market of our choice is the PPF.
Hmm.
And the value of our choice is the value determined by the government, which is our unit. Now,
Hmm.
that one unit which has gone into debt instrument, the next unit should go into a commodity based instrument.
Hmm.
You should try to have a 1:1 ratio. You should try to have it. So, therefore, your next 1.5 lakh goes in the sovereign gold bond.
Okay. Let me
Now,
actually continue. Sorry,
yeah.
continue.
Yeah, so we discussed that the PPF does very good if the rupee appreciates in value,
Hmm.
right? But what is the instrument that does very well if the rupee depreciates in value? Answer is gold. More
Hmm.
rupees are required in order to take the same unit of gold,
Hmm.
right? So where
Hmm.
we are taking PPF for 15 years to 25-year period, that is, we are making an argument that the rupee is likely to appreciate over a 15 to 25-year period. We are taking the sovereign gold bond for an 8-year period, which means we are arguing that the rupee might depreciate in the short term, in the
Hmm.
8-year period, but in over the long term, the rupee might appreciate, which in my opinion is a quite reasonable bet to make.
Hmm. Makes sense.
And the
Actually, I
fact that
had a so I actually wanted to go back to the PPF for a second because there is one thing that was in my mind for a very long time, and I think I should ask you this, is the fact that 2 points basically. One is, I, as an individual, let's say I do not plan to go outside of India. I do not plan to have any transactions in other currencies. I earn in rupees, I spend in rupees. How does the strengthening of the rupee help me in a day-to-day basis? The second is, the reason I'm asking you these questions is I'm also not an economics student, so maybe these are obvious answers, but I am not aware. And the second is, PPF has a 15-year lock-in period, and you can take money, some amount of it out after 8 years. My question is, for someone who is able to save 1.5 lakh rupees, but he's only able to save 1.5, does it really make sense to have it all in a PPF? Because if that person needs some money, let's say 2 years down the line, he can't take that money out. And in that sense, what would you propose? So these two questions.
Yeah, so 2 years down the line, that takes us back to the initial part of the conversation where I said that you have the option of an auto sweep in your bank, which will
Hmm.
link your savings account to an FD account, and whatever is the prevalent rate of FD will be applied to that value, provided it stays in that account for a period 3 months or more.
Hmm.
So if someone has a 2 year contingency, that is, let's say, for example, someone is anticipating maybe marriage, maybe huge personal expense in some way, like foreign travel for
Hmm.
temporary periods, holiday, anything, whatever be the reason. And if it's clearly earmarked that in 2.5 years, 2 years, this money has to go away, then obviously you can't put it in the stock market or the crypto market. That's
Yeah.
that's just taking unnecessary risk for money, which is because what happens if you lose that money is you lose quality of life. So
Hmm.
if you were planning to use that 2.5 lakh rupee to maybe do the interiors of your house, and if you go in the stock market and instead of appreciating uh, by 15% in 2 years, you reduce it by 15% by 2 years, so it will compromise the interiors of the house that you were initially planning to do,
Hmm.
which overall lowers your quality of life. So
Hmm.
we cannot take risk on quality of life, experience of life, right? So the question is, what do we do if our money is less? Then we come to a tacit acknowledgement that if I cannot invest in the PPF only comfortably, the
Hmm.
remainder of the market is of no it's of no use to me.
Hmm.
My concern has to be to either widen my sources of income, which means I should have more than one income source, or to enhance the depth of that income source, which means I'm a full-time employee. This current company pays me, say, 25,000 rupees a month. I'm going to make a jump to the next one if it pays me 35,000 rupees a month. It doesn't matter,
Hmm.
right? Because your first target as an individual has to be able to satisfactorily allocate at least 12,000 rupees a month per
Hmm.
for 15 years. If you can't do that, then you're taking too much risk by going anywhere else. And by
Makes
too much
sense.
risk, I mean, it's my way of saying that you're being stupid, actually.
Makes sense.
Yeah.
Makes sense. No, so when you have broken it down for me, I genuinely understand, okay, why investing in the stock market might not be a good idea for someone who isn't actually able to save the bare minimum to actually uh, invest in a PPF. So I
Yeah.
completely agree in the sense, like, it actually has made me think, okay, maybe I should relook at what I have done in the past 3 years, because for me
Yeah.
PPF was never an option from the beginning itself. I think I told you in my first when we had our first chat, like, a senior of mine in college got me into the stock market and the crypto market, and for me PPF became an option, like, I think last year sometime, wherein I thought, okay, it's just a good idea to have an account open wherein I can put
Mm.
some money in and just let it be. So, but it makes sense wherein if I am not able to comfortably invest in something for a long period of time, it doesn't make sense for me to invest something that's super risky compared to that for even a short period of time, because I might just lose everything that I have, which makes
Yeah.
sense. Having said
Yeah.
that, now to the second point of my question is the fact that how does the currency appreciating make a lot of difference for me as a normal average person living in India, spending money and earning money in rupees?
It makes all the difference in the world for you, actually. It just makes too much of a difference because everything that
Okay.
you purchase,
Hmm.
yeah, because everything you purchase
Hmm.
has its origins at some part of the world, and you can simply purchase more. For example, if you're wearing t-shirt, and
Hmm.
let us say the cost of cotton is X units a bale of cotton,
Hmm.
right? Or with X rupees, you could buy one bale of cotton. Now today you can buy it at X divided by 3.
Ah, okay.
So yeah, because cotton has an international market, soya has an international market, orange juice has an international market, coffee has an international market. You name the commodity in the
Hmm.
world, it has a market. And everything that we consume is a commodity.
Hmm.
Everything
Hmm.
has some element. I mean, I'm not talking about pure service here, but I'm talking
Yeah, yeah.
about what enhances or improves our quality of life, like television or watches or cell phones. They all are commodity derivative in some way.
Hmm.
And if the commodity skyrockets in the
Hmm.
world, it is very difficult for inflation to be in control.
Hmm.
If inflation is not in control, it is typically some currency somewhere is getting taking a thorough beating.
Okay.
So, which would mean, let's say there is a hyperinflation kind of a scenario in Zimbabwe or what was in Argentina earlier,
Hmm.
uh, and there is a low inflation or a stagflation kind of an environment in, say, some European country at that point in time. If you take the global average based, global weighted average of the world inflation at that time, it will come pretty close to mimicking the inflations in commodity market, energy market, etc. Things that we consume.
Okay. So,
So it's a big deal.
like, sorry, continue. Sorry.
Yeah, so if it's a big deal if, say, for example, tomorrow US or China or Russia were to go into hyperinflationary environments, because
Hmm.
all of a sudden the weighted average has shifted towards a hyperinflationary environment. But it's not such a big deal if like smaller economies like Maldives or something gets into a hyperinflationary environment. It would not impact anyone else other than the few thousand people who are living there.
Hmm.
That
Okay.
extent, I'm saying. Of
Hmm.
course, it would be negative.
Yeah.
Crime there would increase, which would make our marine securities weaker, which would increase our expenses. And that's a complete chain reaction. But this is
Hmm.
captured. This is what we're trying to say. Our investments have to capture that. So
Hmm.
investments, debt instruments are made because for a very long time is because you believe your currency is at least going to remain at par. If I believe my currency is going to reduce in value, then why would I go in a debt instrument at all?
Hmm.
Which means that if I were to buy a pair of shoes today, which cost me 5,000 rupees, and these same pair of shoes next year would cost me 6,000 rupees, and this is known to me,
Hmm.
is that there is an ongoing inflation of 20%, and my banks are giving me interest of 10%, then why will I save it? Why will I go even in a short-term debt instrument, let alone a long-term debt instrument?
Hmm.
So
So,
if we are not, yeah, we are not in that environment, and therefore since we are not in that environment at the moment, we are taking a bet that it is unlikely that we will be there in the next 2 decades.
hmm.
It's a bet. But what happens in case that doesn't happen? And that is where the gold bond comes in.
Hmm. Makes sense. Makes sense. So, putting
Yeah.
it simply, how do I actually? I don't know how to simplify this. I'm getting a little confused here, because I'm
Hmm.
also, so for me, inflation, hyperinflation, and all of that also might be too big of words to understand. But I get your idea. And to put it simply, the reason why our currency strengthening over time will make a difference in my life is simply because I might just be able to buy more things in general from,
Yeah.
let's say, right when I was in school, a orange bar used to come for $5. I
Yeah.
bought orange bars for 5 rupees, 10 rupees. Now they are for 20 rupees. Even 40 if you want
Yeah.
to buy the same size as what I bought for 10 rupees. What, in a very executionary or practical sense of the way, what you are saying is that orange bar that used to cost me 10 now costing me 40 will, let's say, only cost me 45 10 years down the line.
Yeah. Which is better today? You just answer that question. What is better today? Being net worth 1 million rupees or being net worth $1 million?
$1 million.
Yeah, because we know that
Makes sense.
$1 million being is like 8.5 crore rupees. Now
Huh.
let's say you are worth 1 million rupees only today.
Hmm.
For some magical reason today, you wake up next day in the morning and the rupee has appreciated 85 times against the dollar. So all of a sudden you're worth $1 million
Yeah.
for nothing that you did, simply by holding on to that million rupee. You simply held it, you didn't spend it, and next day you woke up and you're a $1 million millionaire now. So from
Hmm.
the world economy sense, you are far richer today. Which what does far richer mean? Far richer means enhanced quality of life. It doesn't mean anything else.
Huh.
It means
Yeah.
you can consume whatever it is that is required in order to enhance your quality of life.
Hmm.
So if your currency indeed appreciates and you held on to that currency in the phase of it appreciating, now we are not saying that it will appreciate 85 times, nor are we
Hmm.
saying it is going to appreciate tomorrow. But we are
Hmm.
saying that it is unlikely to weaken at the rate that it was in the past. And over a 2 decade period of time, or 2.5 decade, because you can even increase the PPF by 5 years in blocks.
Hmm.
Over that period, it is likely to strengthen against quite a few other countries in the world, and maybe even beat the dollar and buck the trend, so to speak. It has already done this against the other major economies. So why not?
Makes sense. So
Uh,
now again, this is while I understand this, one thing that I would like to put it for someone to invest in PPF on a fundamental level, they are betting on the fact that the Indian currency will appreciate. So for someone
yeah.
who believes for whatever reason that the Indian currency will not appreciate and it will depreciate on
Uh,
so some for a person like that, you would say that it doesn't make sense for you to invest in a PPF.
Theoretically, it doesn't make sense because if the PPS is giving you 8% and you believe your currency is going to devalue more than that,
Hmm.
then why would you invest into a PPF then?
Hmm. Makes sense. Makes sense. So
But
that
then such a
was
person should have a net zero bond portfolio because PPF is the best bond instrument for an Indian
hmm.
citizen. So the question is, should I have a bond instrument at all? And my argument is that this information about currency is useful when you're making purchases and spending.
Hmm.
And when you, let's say you save 1 crore a year, no,
Hmm.
you can put 1.5 lakh in the PPF. What to do of the remaining money?
Yeah.
So this is where the framework is coming that, and the thought process gets developed at this stage. Now, let us say you are, like you said, that terms of economics, let's say, overwhelm you. All
Hmm.
right. So if they overwhelm you, they might overwhelm someone who maybe just say have a qualification of fifth grade and maybe today is doing skilled labor or unskilled labor in the
Hmm.
country. Okay, so they got overwhelmed by these terms. They didn't understand these terms. Still, what should they do with their first saving, PPF?
Okay.
And why? Because no one can take that away from you, and it will grow, and it will be
Huh.
net positive for you. Because if your country's inflation records 10%, your government will also give PPF as 12 to 13%. Because, like I said, it's the only subsidy that is given to you.
Hmm. So you mean to say
PPF,
even if it were depreciating, the government would compensate for that fact?
it has to do it. Otherwise, no one would invest in the PPF only.
Huh.
PPFs have
Okay.
even given 18-20% in the past, but that time even the inflation was pretty comparable.
Huh, makes sense. So in the sense, like, no matter what happens, even if it is depreciating for a person who still believes that the currency will decline, it still makes sense because even if it while it's declining, the government will compensate for the fact that the currency is declining and they will give more interest.
If yeah, they have to because if the
Huh,
currency is declining, same bale of cotton has become more expensive, so your country's inflation is rising.
huh.
And if
So,
the
huh.
country's inflation is rising, the interest rates are pegged to the inflation.
Hmm,
And consequently, not just the PPF, every instrument in the debt market will have to adjust for that. Because if the debt instrument cannot match inflation, then no one will give debt.
huh. So then it won't make sense for actually to people
And
lend
that is when
money.
your economy, that is when your economy shuts down. You have a good profitable business which
Hmm,
can generate to 15% margins. But currently, the inflationary environment is such that it is, say, at 20%. And now no one wants to loan you money at less than 20%, which makes no sense to them. And your business runs out of liquid capital. That is when actually recessions trigger in.
hmm. Okay.
Functioning businesses cannot raise capital simply because they cannot meet investor demand. And investors have a demand which is pegged to certain macroeconomic influence. See, we are having this conversation as a medium of even educating you and by you people like you. That's the reason why we are talking at length.
Hmm.
Otherwise, the simple answer is that you give me 5 reasons why a person should not invest 1.5 lakh rupee in the PPF. And I'm quite confident I can counter all of them.
Hmm.
The reason is, like I told you earlier, is because I would have had couple or several investment cycles more than you. So
Hmm.
you have seen LinkedIn title, right? Like retired at 33 and SEBI registered analyst, trader, etc. The primary reason why I'm retired at 33 has got nothing to do with the trading. It has got to do with the fact that from the day I was born, my father went and put me into a PPF. He created an account for me that I'm not even aware of. And it came out at such critical intervals of time in my life that when it came off, like the first PPF installment, when it came off, we could outright buy a house. And then
Okay.
that house we gave on rent.
Hmm.
And that rent, after collecting for a few years, we sold the house. See, the
Hmm.
amount might not be enough for you to be able to buy a mansion, but the amount is significant enough for you to be able to create an income source 20 years later, which is relatively risk free, riskier than a PPF.
Hmm.
But like if I have a house, a small condo or a small house, it is far safer as an asset class than running a business. But of
Yeah.
course, I had satisfactory money even to create a small business, but that is not how our family was wired, because security and safety was still quite paramount when I
Hmm.
was in my 20s. It is paramount even today. So now the question is, how does this 1.5 lakh when does it start overwhelming you? So this rule of having a 1.5 lakh PPF, having a 1.5 lakh gold, we
Hmm.
discussed. What do we do with the remaining 1.5 lakh? Answer is national pension scheme. Why national pension scheme? Because it is a mutual fund with the least expense ratio in the country.
Hmm.
That's why. For example, if there is a mutual fund with an expense ratio of, let's say, I don't know, 1.25%. All
Hmm.
right. And that mutual fund gives you a CAGR of 12.5%.
Hmm.
So it took 10% of your profits in the process.
Yeah.
Compare the same mutual fund with the NPS. It has to give it to you. If it's 1.25% outside, it'll be 0.4% in the NPS. And now this fund also gives you 12.5%. Now what did it do? It took 3% of your overall profits. Where's the comparison now?
Hmm.
So now we are looking at 1.5 lakh in PPF, so that I'm actually placed in the debt market. Then I'm looking at 1.5 lakh in sovereign gold bonds. So now I'm even placed in the commodity market. And
Hmm.
then I still have money. I still have money. So I
Hmm.
put 1.5 in the national pension scheme. And now I'm placed even in the equity market and in the retail debt market, because if you're 25, then typically 20 to 25% of your money will be in corporate lending, not in PPF. So risk of loss is there, but risk of higher returns is possibility of higher returns is also there.
I didn't get the last point that you
Yeah.
like
So like
corporate
if
lending
you
and
invest in, yeah, yeah. So it is mandatory for a national pension scheme to allocate a percentage of the capital in the debt market
hmm.
uh, as a function of the age of the investor. So if you create a NPS today at the age of 25%, very likely 25% of the money that you put in is going to go into some debt market. Some debt market. It is not in
Got
your
it.
control. Like it could be private lending, like some, if you've taken an Axis NPS, it could be possible that Axis is lending that money to Bajaj. And they are
Okay.
not doing it at 8%, they're doing it at a higher rate, because there's a greater probability that Bajaj will fail than compared to a bank or the country itself. So
Hmm.
higher risk, so they will be putting it there, but it's a mandatory. Now, if someone were to make an NPS investment at the age of 50, then 50% of their money is going to
Okay. In
debt.
the net. Okay.
Yeah, private debt market, secondary debt market.
Hmm.
So in other words, with the combination of PPF, sovereign gold bond, and the NPS, you are officially positioned in the debt market, the commodity market, and the equity market. Now, something has to run in your 15, 20, 25-year period. Something
Hmm.
has to run. In case of hyperinflationary environment, your commodities will run. In a case of a stagflationary environment, your PPF will really perform well. And
Hmm.
in a case of genuine robust growth, like imagine a scenario where your currency also strengthens and your stock market also appreciates. You're rich now. You're rich. There's no argument. Look at what happened in Japan.
Hmm.
People look at Japan in the year 1947, 1945. Why they look at that year? Because obviously we know it was ruined after two atomic bombs. Even today, any country would get ruined. So back then they were ruined. So they literally started from scratch, right? By
Hmm.
scratch, I mean that the Nikkei was valued at, I don't know what, like maybe 50 or 100 or something yen. All right. In 1945, 1950. By the year 1992 came, that same Nikkei, which was valued at, say, 40, is now valued at 40,000. I'm just giving these numbers out of memory. Or
Hmm.
Nikkei valued at 30 was now valued at 30,000, 32,000, for example. Right. So all of a sudden, we are seeing 1,000 times
Hmm.
increment, right? 1,000 times increment in valuation of the Nikkei, which is close to 1 lakh percent increase in
Yeah.
valuation of the Nikkei. That's impressive. So we all know today Japan as a rich country,
Yeah.
but that is not the real growth. The real growth is staggering.
Hmm.
All right. Why? Because for the same period, the rupee depreciated against the dollar from 6 to 32,
Hmm.
roughly 5 times. The rupee depreciated to the dollar, and the dollar depreciated to the yen roughly 3 times in the same period,
Okay. Uh,
which means that in rupee terms, that 40 yen, that 30 yen, which became 30,000 yen. So 30 yen was 30 yen for us in rupees also. There was some value. But because the rupee depreciated 15 times against the
hmm.
yen, that 30 yen, which became 30,000 yen, actually was worth 4.5 lakh yen for us. Now, if you calculate the growth, it is
Hmm.
absolutely mad what the Nikkei experienced from that period. In rupee terms, it's insane. And that's the reason why companies like Sony, Panasonic, Mitsubishi, these companies became household names across the world.
Hmm.
They were, what is Apple today is the equivalent what they were at that time.
Okay.
Dominant in their market.
Huh.
Toyota, Honda, absolute. They became household names across the world. There's not a country in the world that doesn't know. It's as
Yeah.
ubiquitous as Coca-Cola almost.
Hmm.
So how
Yeah.
did that happen? That happened became because somebody generated so much wealth, and what is generating so much wealth means that goods and services were consumed by the world.
Hmm.
That is what it means, that your stock market, which is your Nikkei, appreciated and the currency also appreciated. Both happened simultaneously.
Hmm.
So what happened to their interest rate? Their interest rates became negative.
Yeah.
See,
Oh.
it's all linked in a way. It's all linked in a way. And just to add to the point, I don't want to overwhelm, like in the sense that because I have studied economics as a part of some academic curriculum,
Hmm.
but I'm also a trader. And
Hmm.
after becoming a trader, like the first things that you learn in economics is, like, demand is inversely proportional to price.
Hmm.
If a price of something increases, the demand falls. That's the first thing you learn in economics. The first thing you learn in trading is the exact opposite, that if the price of something increases, the demand is also increasing. And of the two hypotheses, when I place them in the market, I realized I make money in the second, not in the economics principle. So economics at best is arts. All of these terms are just intuitive judgments put there mathematically. I don't see economics as a science. I
Hmm.
I can challenge literally any economist to predict the next market crash. And I can show you hundreds of cases when Nobel laureates in economics would have got it wrong by huge margins. Maybe 2 weeks before the Great Depression, they would have come up with a quote that this is the best market in the world. That's how wrong they got it.
Okay.
Yeah. So economics is not science. It's basically an individual's creativity represented mathematically. And similarly, trading is not science. It is also an individual's creativity put into practice.
Hmm.
And so yeah, so I wouldn't be too concerned if I didn't know terms like stagflation. I was very concerned about learning these terms. I was very impressed by my economics faculty, but when I came to applying these concepts, I was like, these are absolutely, I mean, they are not very useful for me.
Hmm.
So that's just my point on economics. And the summary would be that invest your 4.5 lakhs in these 3 units into
Hmm.
PPF sovereign gold bond, and the NPS. Invest, let's just say, one third of this in your health insurance. All right. Like get insured for say 50,000. And that takes care of you for 5 lakh rupees a year. It takes care of you for 5 lakh rupees a year. Now, let's just say you marry. So now you have a spouse.
Hmm.
So what is the ideal personal plan for her? The same that is for you.
Hmm.
So now that takes care of 10 lakh rupee a year, which means your household needs to save 10 lakh rupees a year in order for you to think of something else.
Okay.
Now go and say you have two children.
Hmm.
Now your household needs to save 20 lakhs a year in order for you to go and think something else. See, in all of these cases, each of the family member is in the most secure debt, secure commodity, and the least cost equity product in the
Hmm.
country,
Hmm.
right? And it takes a household, a unit household, to save more than 20 lakh rupees a year to even come in the stock market, direct stock market. And this is the reason why I often argue that all this financial gyan and all of this investment advice is not required for, it's just not required actually. I mean, if you're not doing this, then where are you going? Then where are you applying your mind?
Hmm. Hmm.
आपका बेस सिक्योर नहीं है और आप बिल्डिंग खड़ा करने जा रहे हैं.
Hmm.
It's
Actually,
unreasonable
one
to do.
thing hit me. Let me just stop you for a second. You said that once your PPF is done, once your gold bond is covered, once your NPF is covered, which is around 4.5 lakh rupees, after that
Yeah.
you should think of getting a health insurance.
No, I mean, so I wouldn't say after that you have to get, I mean, you need to have an health insurance. I just gave a round figure, 50,000 rupees. Your health insurance should always be there.
Hmm. So
All
even
right.
before the PP, would you in terms of uh like
No,
you have
because
a
I'll,
ladder
I'll
things?
preempt, I'll preempt your answer. So in practicality, if you are not saving that much money, typically you are already covered by Ayushman Bharat, which is sort of an health insurance till 5 lakh rupee, any which
Okay.
ways,
Hmm.
right? We are only discussing for a person who's saving beyond 5 lakh now.
Okay.
If he or she falls sick, who's saving beyond 5 lakh rupees a year, saving beyond 50,000 rupees a month. Now, usually such a person is also a breadwinner. And now,
Hmm.
what do you do if he gets critical illness, which doesn't immediately kill you, but keeps you ill for a seriously long time?
Hmm.
Right? So health insurance, so 5 lakh rupees tak ka health insurance is pretty much covered for everyone. And if this individual who's saving 50,000 rupees for himself, sorry, 5 lakh rupees a year for himself, must get health insurance. I mean, where's the question? Because health
Hmm.
insurance will charge you anywhere between 1 to 2%. So to get a 5 lakh rupee health insurance, you have to pay a premium between 5,000 to 10,000 rupees, depending on the cover.
Hmm.
And anything beyond that, you will obviously take a top up, a super top up, you know,
Yeah.
like that will be between 0.5 to 0.75% of the base. So
Okay.
I wouldn't assign a ladder to it. Like say if I just saved 1 lakh rupee a year, I would invest let's say 25,000 or 30,000 in the PPF, 30,000 in the sovereign gold bond, 30,000 rupees in the NPS, and 10,000 rupees would go to the health insurance.
Hmm. Okay.
But
Huh. So in the sense,
yeah,
you what you're saying is
I
that
look at them as the same horizontal.
huh,
I don't
huh,
see
huh.
them as a vertical ladder. I see them
Yeah.
as a horizontal. This is your base, and you keep adding to it till you are deploying more than till you're deploying 5 lakh per person per household.
Makes sense. Makes sense. So that's what I was stumped with in the sense like for me what I was thinking when you were explaining all of this was the fact that you invest 1.5 and then you move to the other. But this makes
Yeah,
now it makes much more sense in the sense that while 1.5 is your base unit, which the government has created, or in this case, what you must do is create your own base unit, which in which case you can make a 1 is to 1 is to 1 is to zero point 0.1 ratio of your investments. For
yeah,
example, if I were to only able to save, let's say, 100 rupees in a month, in a year, sorry.
yeah,
You mean to say 30 rupees in the PPF, 30 rupees in the gold bond, 30 rupees in the NPS, and then 10 rupees in your Insurance.
Health insurance.
Yeah.
In your insurances, yeah.